Today's video, we're going to be talking about what kind of an investor are you? Socrates told us, know thyself. And when you're investing for retirement, you want to be very careful to know exactly who you are and what you can and cannot tolerate. In 20 years of working with literally thousands of individual clients, I've come to find that individual investors kind of come in two different forms. They come in a moving away form, or moving away from form, and they come in a moving towards form. So both have benefits, both have drawbacks. So let's try to discuss that today. Now, the moving away from investor, this is the person that is not by nature a gambler. They want to keep their money safe and they don't want to take a lot of risk with their money. Now, on one hand, that is extremely advantageous because we know that they will experience a lot less volatility because they're just naturally safer with their money. And it's likely that by the time they get to retirement, all of their money will still all be there. But they tend to have two things that work against them. The first one is that they feel somewhat kind of handcuffed. You know, when you look on the conservative end of the scale, you must understand that you're going to be very limited with the tools that are in your toolbox. Maybe you're going to be looking at things like government bonds, maybe institutional CDs or CDs through the bank. Maybe you're going to be looking at fixed interest annuities or money market funds in your 401k or a stable value account. But that then kind of leads to the problem, and the problem can be financial pneumonia. You see, oftentimes we tend to forget about inflation, and inflation is very real. And the reason I call it financial pneumonia is because you don't see inflation, you don't see it coming, you don't hear it coming until it's too late. And so all of your money might be sitting in a CD, it might be earning, say, 2.25%, and that makes us feel warm and fuzzy as a moving away from investor. But the problem is that if inflation is at 3 and our money is making 2.25, we know that we're losing ground, right? More importantly, as we get into retirement, the other thing that we must consider is the fact that you're likely to be consuming goods and services that have a higher rate of inflation than the norm. So an example, I'm a father of 4, so when I buy a family vehicle, I buy a minivan, okay? When you are retired, you probably don't want to drive a minivan. You probably would prefer to drive a Chrysler 300 or a Cadillac. You've worked and you've sacrificed all your life and you want to be able to enjoy some of the finer things in life. But those things tend to come at a higher cost. I go on vacation, maybe we stay at a Days Inn. You go on vacation, maybe you stay at a Hilton. Oftentimes, we also have to look at another area of healthcare. You know, as a older individual who's getting into retirement, there's a likelihood that you might visit the doctor more. You might take medications more frequently than you did when you were in your 40s and 50s. As a result of that, you know that those things have also a higher rate of inflation than normal, okay? So bear in mind that if you are a moving away from person, you have limited supply of different types of investments. You also realize that you could be losing to inflation. But here's another key concern. What happens if you're a moving away person, you're fairly comfortable with the real safe insured investments, but you have tax qualified money, meaning money in a 401k or money in an IRA? Well, when you turn 70 and a half, the government's going to require you to begin taking money out of those things. And they're going to start you out at about 3.6%. Now, 3.6 doesn't sound like a lot, but what if your money was only making 2.25% in that CD? Well, now you have a major problem because now what's going to happen is because you're not making enough money on your money, you're not getting a big enough yield, you're now cannibalizing your principal, all for the benefit of the government. Doesn't make any sense at all. So we'll talk about the cure here in just a moment. Now, the moving towards person. Typically, these are people who are very assertive. They have a lot of goals. They want to be able to see things, do things, experience certain things, go places. And they've kind of been taught over the course of life that the bigger the risk, the bigger the reward, so let's put it all on the line. Oftentimes, I find that individual investors that have been that way As they get older, they continue to be that way. And that means that most of them will have a propensity to keep their money invested in the stock market, either through individual stocks or stock mutual funds. But the problem is that they will often look at things on the conservative end of the scale, and they will completely disregard them. Because in their mind, it doesn't pay them enough. It doesn't give them a good enough yield. And you know what? The reality is they're absolutely correct. It's not going to put points on the board the way that they want. So they just continue to do what they've done. Another thing that we have to kind of contend with when you're a moving towards person is you tend to develop a bit of resistance, or maybe a bit of, you just seem to not be affected by volatility as much. You become kind of indifferent or immune to it. Let me give you a prime example. In, I believe it was October 1940, London was preparing for what they called the Blitz, and it was basically where Germany was going to be flying over. They were going to be dropping bombs. And the government was very, very concerned about the people in London. And so what they did was they believed that there was going to be millions of people murdered through the bombs that were going to die. They believed that there would be all sorts of rubble. They believed that there would be all sorts of psychological side effects of all the bombing that they were expecting. And so they put up all of these psychiatric wards all around London. Well, the Blitz occurred, and all these bombs being dropped for a month and a half every single day on London, it was very interesting. It had the absolute opposite effect. Now, the government was very concerned, and so they had come into London and they had implored as many people as they could to move into the country. Those are the moving away people. Those are the people that wanted to move out. They didn't want to have anything to do with it. But there was a number of people that decided that they were going to stay in London. And of course, they got bombed, and there was basically three types. There was the person that actually had the direct hit. They died. There was the person who had basically a near miss. That was the person that maybe the bomb landed in the house next door and it didn't kill them, but they felt the shock. They felt the intense feeling and thunder of the bomb hitting and destroying the home and potentially killing the occupants. Excuse me. And then there was the people who were they were removed somewhat even further, and they were kind of sitting in a position where maybe they were 6 blocks away. Well, unbeknownst to the British government, what they realized is that because the people were so inundated with the bombs, and those that were dead couldn't spread any concern or panic or mass hysteria, the people that lived that didn't die, whether they were a near miss or they were 6 blocks down, they started to develop an indifference, and they started to develop a bit of a, well, I survived, look at me, and who cares? In fact, there's stories of children playing basketball in the streets while the bomb sirens are going off and bombs are being dropped in London. It was just another day. They got used to it. They became immune to the risk. Well, the problem is that sometimes stock market investors can have that same thing. They went through the first major correction in 2000 to 2003 where the stock market lost 50%. Then they went through the second stock market correction where they lost 63% from 2007 to 2009. And they feel kind of 10 feet tall and bulletproof. They feel a little bit invincible. But the reality is that now they're getting into retirement, and now it's a totally different ballgame. Now they know that they can't survive simply and solely on Social Security. They're going to need money from what they've saved for retirement. And so we have to be very careful to understand that there has to be a change, but oftentimes they don't realize what kind of a change they could make. So what do? Well, the best result is to maybe look for both parties, whether you're a moving away type or whether you're moving towards type. Maybe the best approach is to look somewhere in the middle. And what I mean by that is this. You see, the wealthy are very careful how they invest their money. And they're very careful to invest their money in things that are creating interest and dividends on their money. And what this basically means is their money is continually earning money for them. You see, when I have money in stocks, if the stock goes down, now I have to wait for the stock to come back up before I can say that I break even. And it has to go beyond that even more before I can say that I made any money. And oh, by the way, I can't say that I made any money unless I sold it there. Whereas if we decide, you know what, maybe I will need income in retirement, and maybe I shouldn't be taking all of this risk on the aggressive end of the scale. How do I do it, Matthew? Well, it's making a paradigm shift from growth and accumulation to now income and distributions. And that means utilizing an entire universe that's in the middle that would allow you to be able to make, say, 4, 5, 6, maybe even 7 or 8% interest and dividends on your money. Now you think about that. Instead of having to wait for the stock market to go up before you could feel like you're making money, or in order to wait for it to come back before you can feel good about selling it in order to get income. Now your working principle is working for you. Your capital is making income through interest and dividends, interest that you can save or interest that you can spend. For the moving away person, realize that there's an entire universe of things. Yes, they have potentially a little greater risk than, say, insured investments on the conservative end, but these are all things that you could put a portion of your money in and be able to raise the overall net yield on 100% of your money. So, in closing, it's important to understand exactly what you are. If you're moving away from or you're moving towards person, realize that there's benefits to both, but there's also some real challenges that you face. And the way that you fix the challenge is being able to educate yourself on the universe of income generating investments. I wish you the very best. Make it a great day.